For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
It is Managing Your Financial Future. Thanks so much. Welcome back to the podcast. Johnny Dean, your host. We got Rick, the Professor Plum, as usual. Certified financial planner professional, accredited wealth management advisor, and a guy who tends to agree with me in just about every turn of this. Why is that? Because Rick has taught me so much of what I already know that maybe it's just, Rick, that I agree with you on many stances.
I wasn't sure where you were heading with that.
Well,
but,
well, I know that if I read something, as I did this past week, if I read something and I say, "Oh, this is ridiculous. Come on." And I send it to you, I can most of the time expect you to say, "What? That is ridiculous." So
is this for real? Are these people really writing this and publishing it? I mean,
right. We are on the same page. So which is always a good thing. So the question I'm asking today, or the question that we're going to be dealing with today, is what if you retire at the wrong time? Now,
what does retire at the wrong time mean?
Well, we're going to get into that. This is the question. I came across an article that I mentioned a second ago. The title, a very wonky title. The title was "Creating a Flexible Retirement Date Window to Mitigate Sequence and Cohort Risk." Okay.
Cohort risk?
Yeah, this is what they call it.
My cohorts? The people around me? Isn't that kind of what cohort means?
You know, I never figured out why they called it that. But okay, so that means that title means nothing to anybody listening to this show. But what it says and why it piqued my interest was because they are suggesting that you should not have a specific retirement date in mind. Rick, do you want to? I know you read kind of the abstract of this. It was a very long article. This had me.
Retirement date windows. So I want to retire at 65. Or maybe 66, or maybe 67. And the driving factor is going to not be my decision. It's going to be what the market does. Is that what you're reading into this?
Yeah, exactly. And when I read retirement date window, I thought, what are they saying? They're saying that you cannot have a specific date, that you should be flexible. Oh, okay. So I'd love to retire at age 65, but, maybe I should just broaden that out a little bit. And why is that? Why do you need a window?
Are they saying you should only retire at a market low? Yeah. So that, or should you only retire at the market high? What are they actually saying here? What is a bad date to retire or a good date to retire? If you can afford to retire at the market low, of course, we don't know when the market low is until we look back at it, then life is rosy going forward. On the other hand, if you take appropriate steps to retire at the market, at what turns out to be the market high, you're rosy there too. So this whole idea is stupid. I'm sorry.
Okay. No, I don't apologize to me. I agree. So what they were saying was, what if you hit your retirement date and the market happens to be in a bad spot, or maybe valuations are high, or returns over the next
spot? That's the problem. What is a bad spot? Okay, so I'm going to retire in August of 2022. The market had reached a peak at 21, and now in August 22, it's down 18%. Is that a bad spot? Is it going to get worse? Or is that actually a very good spot? Because it turned out to be the bottom of the market. And if I actually could have afforded, let's go back to playing the stupid guidelines. If I still had enough money at that point to have a 4% distribution rate going forward, even after the downturn of that early 2022, that's a good time to retire.
You know exactly where I'm going with this. But
I hadn't heard.
Let's take this in order. You already know where I'm going. Okay, so but the bad time meaning that you had $1 million, the market is 20% down, so now you got $800,000. Okay, so you don't have as much as you thought you had when you retired. The argument on this article was that if you set a retirement date, even being off by a year or two, could dramatically change how your retirement turns out. Now, that's what they say. The conclusion they draw is that maybe you should delay retirement. Maybe you should adjust your spending. Maybe you need to rethink everything based on what the markets are doing that exact moment. So you shouldn't go out and say, I'm going to retire on January 1st, 2029, because markets could be bad. So I'm going to have a window. I'm going to make this January 1st, 2028 or January 1st, 2030 or 31. I'm going to try to be flexible enough because I don't like where the markets are going. Rick, this is a horrible. This isn't even a plan.
I'm kind of wondering where to go with this because this is just really idiotic. I don't have a problem of tailoring and tapering and slowing down your work to the ultimate retirement date, not a drop dead date. But what if you thought you wanted to retire January 2000 and the market went down and you stayed all in stocks because otherwise it wouldn't have been a problem, right? You would not have had a problem unless this is only an issue for somebody who is primarily invested in stocks. Which is what most of us want to do because we are greedy and we want the return. And so they say, I'm going to wait another year. 2001. I need to wait another year. 2002. And now I don't have a choice. My window that I built into this thing just shot on me and I have to retire and I have to sell at the worst possible time. And that's just, why are we letting anybody make a decision about a life-changing event that they want to have a control over, that an option on the day you retire? Why are we giving that control, that option, that over to something that we have no control over, like the market? But like I said, what is a bad market? If you can afford to retire when the market is in a downturn, you're going to be great because you're closer to the bottom and you've got nothing but good times ahead. The worst time to retire, for what they're saying, is that just before or just after the market high. But why do I want to worry about something I have no control over? There are so many things that I can worry about that I actually can control. Or if I had the energy, I could control. If I wanted to, I could do something about it if I really felt that much about it. Why am I worried about something I cannot control? You cannot control what happens in the market. And so let's take that off the table. If you do it correctly, if you have the appropriate strategy, the appropriate withdrawal strategy, what happens over the next 5 to 10 years does not matter.
There you go. Okay. Now, then this is where we're going to go on this. As many of our longtime listeners know, they're probably thinking the same thing. Well, I know how John and Rick talk. I know what their deal is, so I agree that it's a bad thing. But now listen, okay. Pretend we don't know anything about the strategy that we've talked about. And let's say you're somebody who doesn't know. I mean, on the outside of it, Rick, though, that is something that's going to get people intrigued because they would say, well, now, wait a minute. Oh, okay. Let me think this out for a second. I retire, and then at the market peak or maybe halfway through a really bad year and my $1 million is only $800,000. I don't have nearly as much as I thought. Now I've got to start taking money out of my $800,000 portfolio where I need 40 grand a year from, or even 50 maybe. I'm taking way too much out. And I'm going to have a big problem because I am going to run out of money very quickly. This is the thought process. You can understand that, Rick, if somebody who doesn't know about appropriate withdrawal strategies. Can you understand that?
Oh, very easily. I can see where people who do not pay attention to this and work with it on a daily basis, can see that as a disruptive factor. But understanding that it will always be a disruptive factor in your planning process, you have to strategize around it, plan around it. And as long as you do that, then you take control back of your life and don't let the markets control your emotions. Don't let the markets control your decision-making process. And there are some people that just can't do windows. Because of the way their job works, or thing. I know that one of the worst things I saw back in the day was the airline pilots that back when the mandatory retirement was 60, and a lot of people were hitting right around the late 50s, early right around the time that they had to retire, and the airlines went through just a devastating downturn. and the airline stocks got killed. Their 401ks got killed. Their pensions got thrown over to the PBGC, the Pension Benefit Guaranty Corp. They didn't have a choice, and that was a lot outside their control. And it just, they got killed because they had to retire at what was a bad time.
Well, and this is what happens. There are people who do not have a choice. Now, this article mentions this, okay? The article says, well, you need to have a window of time. So if you're in a bad sequence, maybe you just hold off retirement. But it also acknowledges that some people don't have a choice. They can, lose their job, get laid off. They can.
How do you know if you're in a bad sequence? I mean, we had a downturn in 2022. We had a downturn in 2023, partially through the year. We had a downturn in 2024 at some point in the year. We were down 15% or so. We had a downturn in 2025 at some point during that year. We were positive in 23, 24, and 25. We were, for the whole year. But what signifies a bad year? What signifies a bad time? What signifies the problems in this? And so each of those 3-4 years had the if we were looking into our crystal balls and everything that the market sayers are looking at, there were some bad times in each of those years. Mm-hmm. Does that mean that, man, I really wanted to retire in 2022, but it looked bad? Okay, 23, nope, got a bad time there. 24, nope, got a bad time there. 25, nope, got a bad time there. I keep doing that enough, I'm not going to retire. I'm going to retire permanently. And the stress of that is going to probably put me into an earlier grave anyway.
Well, yeah. And so their solution then is, Rick, they said, well, if the markets are down and you don't know how long it's going to last, but all you got to do is change your strategy. What you're going to have to do if you have no choice and you have to retire and you don't have a window, well, then you need to adjust your spending. Maybe you need to take, instead of 40 grand, you need to take 30 grand, or you have to adjust your life just a little bit. Okay, these are the exact things that we've been harping on. You've been harping on.
Stupid.
For years and years. But you understand, as I'm reading this, you and I know better, and I'm sure our listeners know better if they've been listening for any amount of time. But when I'm reading this, I'm thinking this would scare somebody who doesn't understand how a withdrawal strategy should work. So, Rick, I want you to – we've acknowledged that if you retired in 2007, Rick, or at the end of 2007 – and you didn't have a strategy, you just started taking money out willy-nilly, systematic
60-40 withdrawal, systematic withdrawal.
You agree you would have had probably big problems going forward, knowing what we know now. And that was
you would have had
time.
big problems on multiple fronts. You would have had big problems in the fact that your overall portfolio, the average balanced portfolio, went down by over 25% in 2008-9 time horizon. So even if I was balanced, and let's say I'm starting with that proverbial $1 million, I'm taking my 40, 50,000, 4 or 5%. Let's just say 40%. My $1 million, I take out 40,000, and it goes down over the year by another 25 plus. I'm sitting at around $700,000. And I'm thinking, shoot, 40,000 out of 700, that's almost a 6%, 5.7% distribution rate. The people that write the articles say 5.7 is too high. I can't handle this. I need to cut back. I need to change. And so I'm worried about my portfolio being a problem, and my mental state is sheer anxiety, which isn't good for my long-term. Well, actually, the two actually help each other, because the portfolio isn't expected to last as long, but the stress is going to make you not last as long. So it doesn't matter, right?
So you need the money for less time.
Yeah, you're going to die sooner because you're killing yourself with stress. No, but the idea is, and at that point, though, the next several years were really good, and you probably came out of it just fine. But the emotional toll it took on you, and the emotional reactions that you take, which then screw up your portfolio even more by selling and by hoarding, going to cash and things of that nature at the wrong time, by letting the market dictate your actions, both emotional and what you actually physically do. That's going to screw up everything all the time. And at that point, we still didn't know how long that, if I remember you and I were on the air talking about this in March of 2009, how we don't know how long this is going to last, but all the experts are saying, oh my gosh, you better go to cash. And all of a sudden, for no reason that we could ever find, the market started coming back. And it was like a day after one of the big shots on the radio, on TV, said, yeah, this is going to be a long one. You go to cash, and he's a famous market, stock picker.
Yeah.
And we're like, well, that's the kiss right there. That means it's going up.
Well, we've been hearing that go to cash, probably throughout all of 2008. And okay, so here's the thing. That was a problem. That would have been a problem for somebody taking a systematic withdrawal, somebody who was doing this the wrong way, quote unquote, from beginning of 2008 on. Now, Rick, you guided people back then.
Oh yeah, we did.
Through times like this. I know, without even asking, that you ran across people who actually did retire in late 2007, early 2000, sometime in 2008, kind of right in the middle of this, as it turned out to be a very, very bad time. So how did we mitigate this? What process do you use for somebody who had no choice in 2008, and retired? How did you make it better?
We didn't expose the cash flow that we needed for the next 7-8 years to the market. So the money that they needed to spend for the next 7-8 years wasn't in the market, didn't go down, didn't lose any money. It did just fine. And we get this quite a bit, and we've received from people who are not working with us, who call us and ask questions, and they'll say, thank you for taking the time. I know you must be busy right now. You must be the phone must be ringing off the hook. And we're like, no. I mean, the market's down, whatever it's down. And so, why aren't people calling and worried about what's going on in the market? Probably because they know it's not affecting their whole life. They're just doing fine. And, back in 2007, we could get fixed, CD rates and things of that nature in the 4% range. And so we had enough money in cash and enough money in fixed accounts to last anywhere from 7 to 10 to 12 years, sometimes 14 years in safe money. The big question wasn't, my God, how am I going to do this? We got to cut spending. It was, you've got 14 years worth of cash. Okay, we just went through a year. We took 1 year out. Now you've got 13 years worth of cash distributions available to you. Let's say we take year 13 and year 12 and put it into the market. It's not a scary thing. It's an opportunistic thing now. So the calls that we get aren't about, oh my God, the world's crumbling. The sky is falling. I just felt an apple on my head. Oh gosh, get me out. It's more of, is this a good time yet? Has it fallen enough yet to get in, to get back in? We've got some extra cash on the side, because the strategy was put in place when they could afford to retire, and we took away the market's impact, the market's short term, meaning 7 to 10 year short term impact on them, and they just, it wasn't a worry, and it's not a worry. And we've been doing this since the mid 90s. We've had a few downturns of note since then, and the outcome has always been the same. We don't get the calls of people panicked because they know that their cash flow is unaffected. And the big question is, okay, A, do I start putting money in? Or B, hey, you know what? The market is down. I mean, there's no hiding that. And we do have money in the market because some of the money is going to, still be in the market. How do we take opportunity? I have an IRA that was worth $500,000 and now it's worth $350,000. Is there room? Should we take some of that, not sell it, but convert it and put it into a Roth IRA while it's low? So instead of converting 1,000 shares, I may be able to convert 1,500 shares, and then that recovery is in the Roth, not in the traditional. Or, and actually, it doesn't hurt somebody with a required minimum distribution where they've got their cash flow covered, and they can always do the required minimum distribution in kind. How do we take advantage? Don't let these things scare you. Find a way to take advantage of it. If you set yourself up correctly the first time and you continue to monitor it to maintain that correctness, you will be able to take advantage of all these things that scare the heck out of people instead of you yourself being stressed to the gills.
I want to emphasize what you just said in that somebody with that strategy is not, I mean, they're not immune to the market downturn. Their bucket 3 is down.
They're just not spending the market downturn.
Right. So it's not that they didn't, it's not that they didn't like, it's not that they liked seeing it go down, but
no.
Knowing there's nothing they could do about it and it didn't affect their cash flow, that had a huge psychological impact on these people. And I remember what you were saying about the phone calls. I had a good friend way back then who worked at a very big brokerage house, and talked to him, and he was saying, this is during the 2000 and 2002 .com burst and all that. And he's just going nuts. He says, I don't even want to go to work. I mean, I don't even know what to tell these people. It's so bad. And I recall, as you said, between, especially during 2008, kind of walking around where you're working there and thinking, man, it's awful calm. So it's not that you avoid the downturns, it's that you avoid
We expect the downturns. We've planned for the downturns. We know what to do in the downturns. And we know that I don't have to adjust my spending. I don't have to work longer. I don't have to go back to work just because the market's down, because I have created the appropriate strategy to deal with it. We expect it. We plan for it. It's one of those, plan for the worst, pray for the best. We plan for the worst. We hope it doesn't happen. And we hope we have nothing but positive returns over the next 5 to 10 years, especially if you're just retiring now. But hey, we can't guarantee that. Nobody can guarantee what the market's going to do over the next 6 minutes, let alone 6 years, 7 years, 8 years. So why subject yourself to the pain that can create? I don't get it. I mean, and people that, talk about, having buckets, a popular one with a big website behind it, thinks that bucket number 1 should be 2 years worth of cash. We've been talking about another gentleman who likes 3 years in cash. Now, at least the guy with 3 years in cash backs it up with 10 years in treasuries. So he's got, 11 years or so, a little bit better. But 2 years in cash, historically, that doesn't even get you to the bottom every time. That just gets you to a point where I can sell it at even lower price.
Well, you think about the person
sell.
You think about the person who had the systematic withdrawal strategy in 2007. Probably, as a good chance, at least some of them by 2010 or 11 have either given up or they've gone back to work or something because they cannot afford to retire. But this contrasts to the people that you dealt with back then, who looked at it like, "Oh, that's interesting. This is opportunistic," as you said. Maybe I can use this opportunity to convert or perhaps buy in. All this kind of stuff plays, and it comes right down, Rick, to the psychological factor more than anything else, because there's a tendency for people to panic and not. I think having the strategy just takes that fight or flight response out of the way, and that's a big part of this, isn't it?
And the panic is the worst part of it. The reaction is the worst part of it, not the market downturn necessarily. I don't want to deal with it. I don't want to do reverse dollar cost averaging. I want to avoid sequence of returns. But if you're dumb enough to do that, then you have to then have enough resolve to not be dumb enough to fall into the trap of reacting to it. If you start with that proverbial million and you lose 25% over the first year and you take $40,000 a year out, you're at $740,000. You have a 5.4% distribution rate going forward. That's not the worst. That's not that bad. It's not 4%. And knowing what we know now, we wouldn't have known this at the time, which is what pushes people to make bad decisions. If you would have known what the market was going to do in 2009, after March, from March 9, 2009 on, 10, 11, 12, 13, you would have just kept up with it because the market did very well and you would have recovered and you would have been okay. But that we don't know that that's going to happen, and so it pushes us to do these stupid things by selling at that 740 and putting it all in cash, and meaning I will never recover from that at that point. And it's all mostly psychological.
Mm-hmm.
It's all about controlling our mind and our reactions. The markets are going to do what the markets do. That you can't control it. You're not big enough to do it. So you have to control what you have control over, which is your reactions. And the way to control that is to stay out the market, man. At least for the period of time that we know that we can't count on it. We can't count on the market for the next 5-6 years.
Yeah. We can't time it. We can't do anything about any of that. But we can do is control our reactions. And how do you control your reactions? By having the cash flow that you need, because really that's what it comes down to. Somebody said the only reason you care is about what your portfolio is doing is because you think, well, I'm going to need that money very soon, and I don't know that it's going to be there. And that's why we do the strategies that we do. So we're about out of time, but just the idea that you can retire at whatever the wrong time means.
Now, first want them, it's like anything else. Define the wrong time. How do I know if I'm retiring at the wrong time without looking backward at it?
Well, you don't. We didn't.
And so how do I make a decision to retire today without knowing whether it's the wrong time for 2, 3, 4, 5 years?
Mm-hmm.
I can't make a decision today based on the future events and know whether this is are you a good time or a bad time? I mean, it's just, you can't say you don't want to retire at a bad time when you can't define what a bad time is until you live through it.
Well, April 2020 sure seemed like a bad time. And then, like 5 months later, you say, no, I guess it wasn't that bad at all. So that's why we take this approach. But it can become a problem if your entire plan depends on what the market happens to do the day you stop working. Okay. And that's, I think, the takeaway to all this is if your income, if your cash flow is tied directly to market performance and you're forced to sell investments when they're down, if a bad year
that's the key. You don't want to have to sell something when it's down, because that takes a temporary loss in value and turns it into a permanent loss of cash.
Yes, and at that point, timing suddenly becomes a big deal. But it doesn't have to be that way, because you build a plan that anticipates all this stuff and says, we don't know when it's going to happen. We know that it's going to happen. When your cash flow is structured, you've separated the money you need now from the money that you don't need for 15 years, then the market does not get to dictate your retirement date. And that's the whole point of what we were talking about today, especially with the bucket strategy. We're not talking about predicting the market. It isn't that. You just have to make sure that your plan works no matter when you retire,
I want to retire today. Is today a good day or a bad time? Is this a good time or a bad time? Nobody can answer that. So the whole premise of this article, the whole premise of this idea is screwed up.
Yeah. You've got it. That's why I said, when I send something to you, or even just a quote, I know when I say that's a stupid thing, I'm going to get it back from you saying, boy, that's a stupid thing. And I say, great, we're going to talk about this. If you want to talk with somebody like Professor Plum about how that could apply to your situation, or if you aren't bucketized and you're saying, that's kind of intrigues me. I really, I don't know what's going to happen. The world seems to be going, crazy right now. Well, reach out to the advisors at Lucia Capital Group. Their phone number, 800-644-1150. 800-644-1150. You know that number by now because I tell it to you all the time. These are the conversations that people like Professor Plum have with their clients all the time and potential clients, helping to build a plan where their income doesn't depend on what the market does next. Vital. You can also visit us online, luciacap.com, LUCIACAP.com. We do have our guides available if you want some more information and some really detailed information on the bucket strategy with all kinds of charts and things like that help point out how it works. You go to that luciacap.com, type in bucket strategy in the search bar, and you can download our guide for free right there. It's a PDF, takes 2 seconds. We also got a Social Security guide, retirement planning, estate planning, and I believe rollovers. Anyway, it's all there right there at Lucia Cap. Don't forget to subscribe to the podcast, Spotify, Apple Podcasts, either one. Do not miss an episode. And as always, we got a lot more topics coming up that we anticipate will help you manage your financial future. We are out of time. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean. I thank you so much for listening. Happy to talk to you. Can't wait to talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrated purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Stock investing includes risks, including fluctuating prices and loss of principal. 401 IK benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Roth and IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Treasury securities are backed by full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.